Hi, welcome to the Property Show. I'm Jayashree Kurup. I'm editor MBTV. I have with me Prabhakar Sinha. He's the real estate editor of the Times of India. As you know, Prabhakar and I have, over the last 3 years, been picking up issues in the real estate industry, whether it pertains to the industry or to the consumers, and we've been actually dissecting them in various panel discussions. And today we're talking about will private equity funds make a comeback in Indian real estate? That statement itself is something that you guys may want to debate. Does it need to make a comeback? Has it gone away? Is it still there? And discussing this with us is a very eminent panel. Rohit Gera, he's always a favorite of mine, managing director of Gera Developers. Kaustuv Roy, the business solutions head of Savills India, a seasoned industry veteran. Naresh Parasrampuria, who's the CEO of Ether Capital, and he's a chartered accountant. He brings a strong finance understanding to the table. Thank you so much for joining us. And let's start. Prabhakar, you want to set the tone for the conversation?
Yeah, certainly. Thank you, Jayashree. Now, this is a very interesting topic, particularly because of this current situation. Now, all the general traditional real estate players, they are in deep trouble, and their main focus today is to complete the construction. So they are looking for the construction funding, whereas all the corporate run real estate companies, they are going for the new launches. And for them, fund is not that big a problem. Now, since the fiasco of ILNFS, now construction funding is not available through NBFCs. Banking sector itself is in a very bad shape. So most of these companies are looking for the funds, private equity funds. Now, here the equity fund is a misnomer because no equity fund is ready to give all these stalled or delayed projects or under construction projects, particularly in the residential sector. The equity fund, they want to give the debt fund. And debt fund too, that's a very high interest rate, upward of 18%. Now, here I want to understand from Mr. Naresh Parasrampuria and Mr. Gera that now in this fight, that whether to debt, because equity they don't want to give because return is very thin around, in most of the projects there is hardly any return, and debt with 21% or 18%, most of these projects are non-viable. So what is and many of the companies, the fund itself have already invested in this company. So now this is a very unique situation in this entire country is into. Now funds like Swami also came in, but because of the first right, they asked to seed the existing lender, which is not possible. So that is non-functional. So these are the very important topics which should be tried to address, and I believe we will address that. So
Oh,
please,
let's start with that basic issue. Did private equity funds go away from real estate? And if so, why? Rohit, you want to start?
Sure. At the outset, thanks for having me, Jayashree. It's always a pleasure to engage in these conversations with you. Private equity, by definition, I think equity, the requirement, equity is a high risk capital. And by virtue of it being high risk, there is an expectation of a high return. What we've seen in the real estate sector in the last 5 years is anything but high returns. In fact, returns, and especially if you look at the balance sheet of the listed players, you'll see that returns are extremely, extremely low. In which case, I believe that the equity investment and equity investors don't see the value in investing in something which is going to have what is literally like debt returns. So I think that's the bigger challenge, which is why I believe that in the present sort of situation, the equity investors are shying away for the majority of developers. I think like Mr. Prabhakar said that that there is no shortage of capital for the corporate and the reputed developers who've got a track record of sales and marketing and the ability to liquidate inventory. So I think that from a time when anybody was willing to fund anybody, any amount, right? Today, very few are willing to fund because of what happened with ILFS. right? There are very few people who pass muster with those few who are willing to invest because of, what happened with developers. And even the amounts then have become much more, they become much more circumspect about the kind of amounts that they want to invest.
Yeah.
So I think from a situation of plenty of investors, plenty of projects and plenty of money, we're down to very few investors, very few bankable projects and very little money.
Right.
And I think that's the kind of shift that's taken place as far as the industry is concerned.
Right. Naresh, let's come to you. When you talk about funds, at one point of time, funds were chasing projects, right? Now projects are chasing funds. Now let's talk about the funds, the equity funds. Tell me the equation between banking funds, debt funds, and equity funds. You're on mute. Mute.
No. You are still a mute, sir.
Yeah, can you hear me?
Yes.
Yeah, okay. Sorry. Equation in what sense, Jayashree?
As far as the real estate industry is concerned, which are the funds that are available to the industry and to whom?
Okay,
It
so
is
as
opening round, so keep it brief and keep it so that we can take it to each of those issues we can pick up.
yeah, sure. Jayashree, thanks for the invite at the outset. And as Rohit rightly pointed out, equity per se, insofar as real estate is concerned, last 5 years, what has been happening is it's by and large only the growth in the sector has been happening because of debt. Purely, one NBFC or one equity funding, then at certain point in time they are exiting, another one is again entering. So by and large, it's happening only by way of debt. And private equity again, yes, the trust factor also again with developers, it's been there with the corporate developers, yes. But insofar as other developers are concerned, you see the mindset has been largely, oh, equity aa gaya, so I will treat that as basically a debt component. So that mindset also has been there with the developers. I'm not singling out anybody, but by and large that has been the mindset. So again, equity has taken a backseat. Again, the notion in the mind of the investor is, yeah, why take this thing called the thing? Okay, I'm getting a return of IRR of 18-20%. Fine, I'm happy. My limited partners are happy. So that has been the call last 5 years. And after ILFS, rather before ILFS, it started happening. It's not again after ILFS. Before ILFS also, largely real estate was funded by, I would say, debt. And again, equity insofar as real estate is concerned, if you see the trend in last 7 years rather, or 7 years or last decade, I would say, it has largely come in commercial space. Residential space has been very, very selected, few with the basically developers who are listed, who have got discipline. So equity has come in there, but otherwise it has come in commercial real estate. And commercial real estate also, you see, again, at certain point in time, you leverage that equity as well. In a sense, after the project is up, you have a concept called as LRD. So you go to a bank, you any lender, discount that, get huge amount upfront, and again you use that as an equity in your other projects. So by and large, again, equity is a sort of masquerade as I would say debt. So whatever equity has come, it's come in commercial space. By and large, it's been a debt funding.
Jayashree,
It's been and I'm sorry.
Yeah, please
Sinha, kindly allow me.
No, please complete.
Yeah. My background is last 30 years. Though I'm a chartered accountant, it's not been audit taxation. It's only been project finance. I do not even know the basic income tax library. So rather than relying on numbers or statistics or whatever, I speak to the private equity players, I speak to the NBFC players, I speak to bankers on a regular basis. So you know what is happening strictly at the ground level. At the ground level, bankers have been given an instruction, no again giving exit to NBFCs. Whatever debt today has been happening is very, very sporadic, very sporadic. Bankers are not keen to fund. NBFCs, again, let me tell you one thing, I will not name an NBFC, but a very large major player. They gave me 4 deals worth about 2,000 crores to sort of to see whether an exit is possible. But when I saw the proposal, In one case, around 300 crore exposure, one case 500 crore exposure. Collectively, all 4 proposals are around 2,000 crores. Now, in none of the proposal, even bankers today are looking at cash flow. See, where is the cash flow? Okay, you talk about principal. I will take an sort of call insofar as my principal repayment is concerned. But at least for the next 2 years, my interest needs to be serviced. So assuming even if this is at 12%, and if I'm taking an exposure of, let's say, 500 crores, I have 60 crores say, of my interest servicing to be done. And if that doesn't happen in 1 quarter, my account becomes stressed.
Right.
So again, you see, debt funding again today is very, very dicey. And my reading is last 10 years equity in residential space is very less. I don't know the numbers because I told you I'm not a statistic man, but by and large, it is very, very limited. It has come in commercial space.
Right.
Thanks.
Prabhakar, before I go to Kaustuv, you want to say something?
Yeah, I just want to understand one thing. That's now, as the equity investor earlier also when they were coming as a quasi debt because they were fixing the return in advance. That I will take your 21% return. You'll have to buy back my share at that price. So it used to be debt only. Now, because of the RBI and other regions, they were saying that no, it is debt. Now the issue is this, that sir, because from that situation, now today at least 80% projects which are running right now are the delayed projects, where most of the juices are out. Delayed projects are delayed or stalled projects, where there are hardly any juices are left in the market. So the issue is this, and so now the financier is just ran away. No financier is there for this project. So now, I mean, what is the solution? Now, if you people will not fund, if you're not ready to fund, say at lesser rates, say return at 11%, 8%, 9%, I mean 2 percentage point or 3 percentage point more than the going interest rate, how these projects will go on, sir? Now, this is the most important.
That's not their job, na Prabhakar. They are not there to ensure that those projects complete. They are a business.
I think we should understand. I think we should understand the role of a fund. The fund takes money from investors, and has a certain mandate to invest in a certain type of project and deliver a certain expected return to its investors. And as such, if some developer or some fund made a mistake, took out all the money, why should anybody come in and kind of step into that mess, if you will, to solve somebody else's problem? I don't think that's their mandate. I agree that a solution needs to be found, but I don't think it's the financing or it's the banking industry who should be looking at that solution. I think it's a joint solution which comes in and it includes the consumers and the customers who've bought and who are also stuck in there, who have to partake in that solution. And Jayashree, maybe that's another sort of conversation for you.
Absolutely.
But as of now, I think it's clearly not. I don't believe that it's the finance industry's problem to solve what others did, and to take care of the excesses of other investors and other developers.
No, before Naresh, before I come to you, I would like Kaustuv to start speaking in the panel.
Sure.
Kaustuv, I wanted you to comment on. There are funds. The funds are there in the market. It's the quality of the assets that is the problem, right? Now, talk about 30% of the market is actually residential and 30% is commercial. When funds pick and choose, how do they pick and choose? And what do you think, will equity funds find a foothold in residential and commercial?
Back to residential. See, if I look at history, there was actually interest from the equity funds to actually get into equity on residential. I mean, as I'm talking about slightly more than a decade back. Now, they were trying to balance the risk-return ratio. Now, the fact is that, look at this way, forget about the funds, even individual investors, they were active in the residential market because that's between booking and delivery, there was a 30%, 40% jump, provided your delivery dates were kind of in a manageable position. Now, what's happened is that why is it that the funds have moved away from equity? Because the fact is that of project delays. Now, project delays may be financial, material, regulatory, or whatever it is. Then they realize that, listen, it's just not making sense because I'm not getting the return which is equivalent to an equity return because the risks are just too high. Okay, so they're all moving to debt. And that's what's happened. Now, today, if I look at it this way, now the fundamental difference between, say, a residential position and a commercial is that where your money flow starts coming back in commercial only once it's constructed. Okay. But the fact is that clearly the returns are not going to be as high on the residential side, as compared to the residential. So I think what's happened is that most of the funds now, there's, as Rohit said, is based on a mandates which they get from the investors. Okay, they're saying, okay, fine. What we do is let's be happy with a lower risk, lower return situation until we are confident that Indian developers on the residential side have the full game in their hands, including regulatory. We don't want a situation where suddenly you've started out on a construction and, for whatever reason, there's a height restriction or some reservation comes in and things like that. Plus, the fact is that there have been new regulations which are coming out day in, day out. So I think that's where the funds call is saying that, listen, let's go at this point of time. And if you see on the last 5 to 6 years, that's what's happening. They're saying, listen, we no longer want those crazy returns. We are fine with lower returns. We are fine with the debt. Let's work on that basis.
Right.
Yeah.
Rohit, in one of our earlier discussions, we had spoken about how you need financial closure of projects for any kind of systematic business to run and to establish yourself as a serious player. You do need financial closure of projects, which means that you must know how you can complete a project before, where the funds are going to come from in case the regular sources dry up. Is that how important is that to the funds, and will financial closure by more and more developers bring the equity funds back, and will the returns to the equity players rise? Yeah, you're on mute.
So Jayashree, I think I've been talking about the fact that we need financial closure of the entire project cost.
Yeah.
At the time the project starts.
Yeah.
Right. And I think, and that was extremely important. I was talking about that initially just purely from the end consumer's point of view, because that ensures that the project doesn't stop for lack of sales and lack of customer cash flow.
Yeah.
Right. Just, in case the market changes and things happen of that sort, those who've already booked don't get stuck in a situation that there isn't adequate cash flow to complete the project. When you actually think about that from the point of view of an equity investor, a private equity investor, it's great from their perspective as well, because again, if the developers put in some amount of money, there's some amount of private equity money, whether it's by way of pure equity, whether it's structured equity or pure debt, either way, right? And then there is construction finance or customer sales. At least that investor is assured that the project gets completed, right? In which case, if the project is completed, then you can take a call and you can take a judgment call which says that, look, let's go ahead and liquidate the inventory even at a lower price, but you can take your money out.
Yeah.
Right. Today the situation is when people are stuck, funds are stuck, there's debt money which is stuck in projects, there's consumers which are stuck in projects, the money's been taken out.
Yeah.
Nobody's willing to put more money in to complete the project. So I think project completion needs to be viewed very differently.
Yeah.
And towards that, I think, I dare say, if you look at, for example, what happens in the US as an example, right? You have full project closure at the time of starting. You have the developer putting in some amount of equity. You may have a private equity player putting in some additional money by way of equity, and that's the first level of risk. If everything goes south, that money gets lost.
Mm-hmm.
Above that, you have a mezzanine equity layer.
Yeah.
And then you have the debt layer, right? And the return of capital comes in the reverse order. So the debt gets paid first, the mezzanine gets next, and then the equity is the one that's most at risk.
Right.
So I think if we believe that the real estate sector is going to continue to see these kind of current levels of return in the medium to long term, I think we do need to see the financial modeling and the capital stack then to start adjusting to keep this new reality in mind. Because the old reality was you buy any land, by the time you get approvals, the prices are up. By the time you start selling, your prices are up even more. Your last inventory gets sold at twice the price. Everybody's happy, everybody's making money. Right? If this paradigm has changed, then I think the financing stack has to also change to replicate this, to kind of take into account this new reality?
You spoke about the US markets. I remember almost a decade and a half ago when I was in the US, I spoke to some people there and they said that yours seemed to be a very speculative model. They called it because it was largely based on consumer inflows and, it was very, very unstructured. If you ask me, a lot of policy has come in and we are moving towards a more structured market, serious players and so on. Naresh, how has policy helped? Has the RERA, a lot of other policies, has it actually brought more trust in the system at all?
Yeah. I'm audible?
Yes, you are.
Okay. So we had structural changes in the economy starting from demonetization to GST to RERA. And after RERA, all the more again, like what you asked Rohit a question earlier, that yes, whether the financial closure of the project needs to happen before you start the project. But it happened, but it did not happen the way it should have happened. In a sense, you have so many projects now which are under complete. And people are looking at what is the only source of option available today is Swami Fund. That's about it. So RERA happened, I think, 2 years back? So even that discipline thereafter at that point in time has not come into the system, Jayashree. And today, many of those projects are stuck. Many NBFCs have funded projects not doing the entire financial closure. Because as I told you, I got 4 proposals from an NBFC totaling to about 2,000 crores. 4 projects. All 4 projects, again, where is the cash flow? I mean, I myself cannot see any skin in the project insofar as cash flow, going forward, cash flow is concerned. And the financial closure has not happened. So they're looking at partly exiting, fully exiting, whatever. So that discipline has not happened.
So what policy do you need to fix this? The problem is there. What policy do you need? What policy interventions do you need? Or do you need policy interventions at all?
Whatever policy you have now, it is a wait and watch situation. You might have solid policies in place now, but after the pandemic, you'd never know what is going to be the situation. It's a wait and watch situation in a sense. Yes, I'm in touch with global investors. They are also sitting on the fence because the valuation of assets globally have gone down, Jayashree. So they have opportunities elsewhere. Now, if I have to come to India, I will again see what is the FDI which is coming in the manufacturing sector. Because of this China factor, yes, whether as a nation we are able to attract FDI in the manufacturing sector. Because you see, real estate by itself, I'm pardon, Rohit is a developer here, so no offense to you, Rohit, but real estate per se as an industry, you cannot single out. It is a backbone of the economy at large. And economy at large today, I speak to a lot of bankers who are in charge of SME, who are in charge of large corporates, the general managers, the chief general managers of SBI, who are in charge of mid-corporate, large corporate, SMEs. You see, there is a financial stress into the system, huge financial stress. And in the latest financial stability report of RBI also, they have said that, yes, the financial stress is there with banks. It is being pushed under the carpet as of now by loan monitoring and all that. Right. So right. I'm talking about the real economy.
Sure, so, I understand. So you're saying the finance sector.
Can you allow me to complete? Going forward, let's say as a developer, as Rohit as a developer, if he has to start a project, let's say the project cost is around 500 crores. Now, point is again, there will not be any equity players insofar as real estate is concerned for sure. Next 2 years, they will not look at a long-term horizon. They will wait and watch as to whether India is attracting manufacturing facilities here or not. That is very, very important. You see, basically an economy is driven by 2 factors. One is local consumption. Second is foreign investment. Yeah. Correct? You talk about cash flow. We talk about a project flow, cash flow, talk about the economic cash flow, inflow and outflow, simple. So today, again, consumer demand, again, you don't know what is it. Guys would like to wait before they take a private equity call. How will you do a financial closure today? Sales, again, you don't know. Whatever sales are happening, okay, there are fantastic, we are gung-ho about sales happening. I'm getting reports from Pune, from Bangalore, from Hyderabad, that, oh, fantastic sales, accepted. It is in OC completed projects or projects which are under completion or branded projects, branded corporate developers, you know. But by and large, what about under construction projects going forward? Financial closure will be a challenge there. And again, the financial closure in terms of private equity will be a huge challenge.
Okay, taking off from what, Rohit.
Just one thing. I think it's important if we look at, if we look at the show, we need to separate out what's ongoing and which are stuck.
Absolutely.
From new projects and, what kind of kickstart and what the future of real estate is going to look like. They have completely different buckets, and I think we should treat them as such.
The legacy problems and the post-regulated industry.
What comes up as we go forward, as we come out of this pandemic, and from here onward, for new projects, what happens, for new customers, what happens, and what happens to old customers and old projects, I think are two very, very different situations and scenarios.
Yeah, okay.
Absolutely.
Kaustuv, taking off from what Naresh said, right? You have legacy problems, you have projects that are stuck and so on, and many people have burnt their fingers. But the point is that there is this, I think, growing breed of professional corporate entities in the real estate sector, which, despite the pandemic, has been able to go on. It's not that they have gone under. That means that there was financial jurisprudence, there was a structured planning, and these are the companies probably which will they attract equity? Because I'm really interested in understanding what is in the mind of that equity fund.
True. See, what I think what the funds frankly first look at is who's the promoters. I think the looking at the promoters and the past track record of project delivery, I think these two are the most critical things. I believe funds are looking at, saying that, listen, I want to go with a partner, whether it's equity or debt, saying that I want to go with a partner who can deliver and who had delivered in the past, and that too delivered in a reasonable time frame. Saying that, okay, fine, you know what, in the last 5 years, if you delivered say 2 million square feet, in the next 2 years, don't tell me you're going to deliver 5 million square feet. That's not going to happen, because that's not what your experience is. Okay, so the thing is that they are comfortable saying that, okay, fine, I'm going with someone reputed, and the product is made to the market. Okay, I think that is something which the new projects which are coming up and people who have reconfigured their products or come up with something which is to the market, I think have done well. Not the stuck projects, the ones which are. So I think what funds will look at is that, listen, we need to understand, when you're saying, are you concentrating on luxury, mid-market or whatever, what's your research? Have you done research? What's the demand? What are the apartment sizes? What are the investment sizes? It has to be strongly backed by research, because clearly today funds are looking a lot more into detailing. Okay, detailing and with background information into what you're going to make. It's just not that, okay, fine, I want to make a luxury project because it satisfies my ego. Classic example, Central Mumbai has got close to about 10,000 apartments, which are minimum 4 to 5 crores upwards. I mean, where's all that going to be sold at? So I'm finding is that the funds are saying, fine, we will pay. We don't have a problem of new projects, not the stuck projects. Stuck projects, we'll have to think of something else. But new projects, I'm willing to put in money. I want to understand your track record, what your credentials are, what is the security that you can give. Okay, besides what is already in this project, do you have a subsequent security which I can feed off in case this goes down? And then I want to understand your product. I think these are fundamentals. I mean, forget anything other investment. These are fundamentals to investments. Simple.
Naresh, 1 minute. I'd like to continue asking him. Just 1 minute.
I want to add what Kaustuv said,
I
want to add what Kaustuv said.
Yeah.
See, we are talking about financial closure of a project, a real estate project going forward.
Yeah.
Now, the means of finance, there are 3 elements. One is promoters' contribution, bank finance, and third is the sales.
Yeah.
Now, going forward, promoters' contribution, again, for them to bring in more equity, going forward again is a dicey situation. So what Kaustuv said is, whether they're going to bring in equity or debt, fine, it's okay. But supposing a sales component cannot be relied upon. Let me tell you one thing, after RERA, particularly after RERA until date, You know how banks used to look at project financing insofar as real estate is concerned? Okay, let's say about 500 crores is your project cost, and you are telling a banker that 250 crores will come out of sales, and 250 crores is my promoter's contribution and my other factors. Now, there, what the banker used to, the trend was I will not rely on 250 crore sales. I will go by the numbers which you have sold today. So let's say you have sold inventory worth 100 crores. I will only consider 100 crores. So out of 500 crores, I will only consider 100 crores. Now you tell me the balance 400 crores, how that has to be, will be funded by debt and equity. So going forward again, whether I'm adding to Kaustuv or kindly don't misunderstand Kaustuv, going forward again for a real estate, that too particularly large real estate projects, investors again, what? It has to be largely funded by developers and the investor. How much will you factor in your sales composition? You don't know after the pandemic. And as Kaustuv said, exactly, what about the 3 crores, 5 crore apartment? How are you going to sell that? You never know. There are no buyers as of today. You know, so that financial closure discipline going forward again will be a huge challenge, huge challenge.
Yeah.
That is my perception.
Prabhakar, you want to say something? You're on mute.
Yeah, the biggest issue today, what I have come to know from the various developers also and the investors also, funds also, that when new launches are happening, at the present going price in that region, the project is not viable. And if they fix the price which is feasible, even at the lowest level, the project, the buyers are not there. Difference is at least 20 to 25%. Now the issue is that now they are saying that, okay, NPV, because here in the new projects, buyers have to pay in 3 years or 4 years period. So the total NPV should come down to that level. Now, because when the price they hear is that, okay, this flat is 80 lakh of rupees in the same area and this is for 1 crore of rupees, okay, fine, that 1 crore rupees has to be paid in another 3 years time. But to sell that kind of a project in new one is not possible, is not happening. And because of that, and the funders are not coming then, because equity is saying that, boss, at this price, it is not viable. And at that price, it is not sold. So where to invest and how to invest? So this is
Let's go to
the
Rohit.
problem.
Rohit, answer that one.
No, and I'll just add to that.
Yes,
And the
yes.
funny part is that your ready reckoner prices are not coming down.
Yes.
Yes.
So everybody is in a soup.
Yeah, exactly.
Don't even get me started.
Yes, don't even get me started either. I think
On the
that
ready reckoner
work
issue
done
is
is-
absolutely ridiculous.
Yes, and
Right. And then you
Rohit,
couple that.
but ready reckoner prices, the problem is that there is no coherent third-party pricing mechanism
Yeah.
available in the industry for the states, for the developers, and nothing seems to be coming up. I think our prop index was the closest to what we had. What you're coming out at Pune is another index, but we need 100 more indices like this for us to be able to say that you got this is the price in the market, credible price monitors. Okay, please.
You know, I think the way I do believe that that certainly the government of Maharashtra was relying on flat purchase agreements to peg the pricing going forward, right? Because keep in mind, they come up with the ready reckoner pricing is done for the next year,
Yeah.
right? Basis the agreements which they've seen in the last few months. So they would constantly up the price, okay? And you raise it 1 year, but the market has gone down, the ready reckoner has gone up. That for the government to realize and react and say, oh my God, because please understand, their revenue a large amount of the revenue comes from this.
Yeah.
So there's a revenue pressure as well. So the first year the real estate market goes down, the ready reckoner goes up. The next year the real estate market therefore goes down further, but the ready reckoner now goes up by a little bit less. So there's this tremendous lag. So I think they look at the data, but I think that they need to be able to be more agile on adjusting the prices, and adjusting the prices downward is not a big deal.
Yeah.
If the market has come down, well, they should certainly just be able to do that. So I think that mechanism issue, you're right, continues to be a problem. So I dare say, if a project is not viable today, right? Something has got to give, right? Why is it not viable? We all know cost of construction, give or take in the region of 10 or 12% up or down. It's, 400, 500 rupees up or down. That doesn't really make or break the project. So what's breaking the project was actually done by the developers. And I'm owning up to that. If we go out and buy land in a frenzy and are willing to outbid each other like idiots, okay, and push prices up, without assessment of return, without assessment of the time that it's going to take to get those approvals, without any of those things, without having the financial closure, with a model of saying, hey, you know what, I'm going to borrow at 21% at the beginning stage of buying this project. I'll get my approvals, I'll flip this over, okay, then I'll reduce my cost to 15%, and then customer sales will happen, and then I'll reduce it to free money, and suddenly the project approvals take 1 year or 2 years. Okay, you're completely sunk.
Yeah.
So I think we are in a situation where current projects which are not viable purely because of the price that we pay for the land, in which case you made a speculative play, right? You bought something too high. Now it's your choice. Either you sit and wait for the prices to rise, in which case if you've paid it from equity money, your own money, you can hold on, right? Or if you've got somebody else's money, well, take a haircut, bring it to market at an affordable price that the market will buy, sell, and move on to live to fight another day.
Absolutely.
You can't, business by nature is risk. Sometimes the risk pays off, and there are times when the risk doesn't. You can't make money on every single project, every single time, all your life.
Right.
And I think, we need to take that into, if you're speculative and take a short-term view of a project, of your business, you're going to get stuck. You have to have a long-term view if you're in a business like real estate development, where typically a project takes 3 to 4 years, and now you have to give a warranty for 5 years beyond.
Yes.
So you better have a long-term view if you're entering this business.
Jayashree, what he's saying is right, but we have seen NCR market getting ruined because of that.
Not only NCR, not only NCR. I think what Rohit says holds
It's
true.
everywhere.
No.
It's everywhere.
But now remember Noida extension. People borrowed money to launch a project, and to repay that money, they launched the project at 2,000 rupees a square feet. Neither those projects got completed,
No,
nor
I
money
think
could be returned.
there, Prabhakar, I would, this is my
And
theory.
look,
I
the
think
entire
after,
Noida extension, Noida market is today is less than 5,000 rupees a square feet.
if
At
the
that
developers
price,
had paid, they had to pay only 10% of the cost, which meant that the cost of land had been neutralized, which is why they launched cheap. But the
exactly.
point is, if they had paid, it had to be amortized over 7 years. If they had paid in year 1, year 2, year 7,
नहीं,
this
जयश्री,
mess
मेरा point है कि उसके कारण कोई नया प्रोजेक्ट लॉन्च नहीं हो सकता. मैं ये कह रहा हूँ.
वो क्योंकि फाइनेंशियल डिसिप्लिन था नहीं,
हाँ,
and
तो
nobody was there to enforce it.
और ये पूरा मार्केट को अफेक्ट किए हुए है. This has
बिल्कुल,
affected the entire market in the India.
I agree with you. And
That's what
here,
I'm saying that.
yeah.
Look, I think there will be examples of sub-markets where the excess has really caused a serious and more of a gridlock kind of problem.
Yeah.
But I think, what I'm talking about is on a more sort of macro overall kind of perspective, leaving the extremes out of it, right? There are certain markets where even today you can buy land today at today's price. You can develop a project and you can still make money. We're doing that, as a business, we continue. A lot of other developers continue to do that. So there are extremes at that end, and there are extremes at the other end as well. But what I'm talking about is the majority of the market.
Actually, the thing is that at the extreme, you have about 7.5 lakh houses, right? And that really changes the equation big time.
Which is more than the 5 years to dismantle or to sell them.
Absolutely. And I think that was a created problem at one point of time where everybody thought Behti Ganga mein haath dho lete hain. That was it. And that's what has happened. Kaustuv, when funds are attracted, you attract funds as a developer. So like you said, the track record of the developer, the capacity to build, if the capacity matches what is projected, those are the reasons why you get it. But even the best of developers can have projects that don't perform for whatever reasons, right? Will that impact the funds assessment? and will that developer stop getting funds? Because one project, completely went off.
See, it's like this, that if it's a one-off case, and if that project is has been kind of not impacting the other overall corporate structure or the corporate stability, then I think it is fine. Because see, they also want to make sure that yes, you might land up doing one project has gone bad. That's fine, as long as it does not impact the financial stability of the mothership.
Yeah.
Okay, that's good.
Yeah.
If that project is well insulated, it's kind of hived off, it's already sitting in an SPV which is not going to come back and bite back the entity level.
Yeah.
Okay, then I think they're fine. I mean, they understand. And today, in fact, if I look at it this way, funds are more than comfortable actually giving funds on a project to project basis, saying that, listen, I'm not going to put it at entity level, I'm going to do it at project to project, because the fact is that entity level, the level of, I would say, the trust or the confidence I need to have with you is going to be multiple folds.
Yeah.
And frankly, at this point of time, I'm not too sure whether I want to put so much of my eggs in one basket.
Right.
I would rather go with, spread my risk, multiple markets. Most probably some of them will be most probably in mid market, maybe one or two of them, maybe at the premium end. But then I want to work with multiple, opportunities. So that's why. So one project, I don't foresee that. But the fact is that, okay, fine. For a developers, if he has 40 or 50% of his projects in a soup, then I don't see funds really going to be very attracted to it. And at the start, I think either Prabhakar or Naresh has said there are more funds now chasing lesser number of money.
Yeah.
So the funds really have a lot to choose from.
Yeah. Okay. I'm going to ask each of you. I'd like all of you to respond to this. Do you think that we have enough policy to clean up this market, or to ensure functional stability of this market? Or do you think that something needs to be done? And I specifically refer to finance. Okay. So is there something that, your wish list? Should the RBI do something? Should the state governments do something? Like Maharashtra got the Deepak Parekh committee to study the market and give suggestions. Is that another option? What needs to be done? Okay, Naresh, you can start. And keep it brief, because I have a couple more things to discuss, right?
Absolutely. So point is again, reducing stamp duty and all that will boost up. That is a measure to boost up sales.
Yeah.
What is most important is, like a manufacturing sector, the real estate sector should do the financial closure at this start. You see, earlier, let's say, as I told you, 100 rupees is a project cost, 50 rupees is funded by debt and equity, balance 50 is coming by sales.
Yeah.
Going forward, you have to scale that down.
Yeah.
What if the sales doesn't happen? Okay, I will only factor, let's say, 10% of my project cost will be funded by sales. 90% going forward, I have to fund it by way of equity or maybe debt.
Yeah.
The debt may come again from the investor by way of structured debt or whatever, but it has to come from developer and from the investor per se. That financial closure is supposed to happen. That discipline should be there in the business as such. No RBI, no government, nobody can intervene there.
Yeah.
This discipline is like the manufacturing sector, which is inevitable for a real estate sector going forward.
But it has to be, discipline has to be enforced. It's an industry which has shown clearly that it was not disciplined, right?
How do you enforce, Jayashree? You can't bring, it's not enforced in the manufacturing sector. Oh, you have to do financial closure. It's a part of the system. So that should come in by way of discipline right from the beginning, that the financial closure should happen. Let's say, assuming there is no bank finance, assuming there is an investor and there is a developer. Okay, now the investor is getting money by way of private equity or structured debt. Fine. Sitting across the table, they have to decide that discipline. Okay, boss, 500 crores. That 500 crores, how much you will bring, how much I will bring. Sales, we will only take, let's say, 10% or 20% going forward. If it's affordable, fine, I may increase my sales component. If it is not affordable, if it's luxury, then again, I cannot factor 50% of my sales component, and going forward, my project gets stuck because of finance. That is where the financial discipline will matter, because the financial stress in the system, Jayashree, will now surface in the next 1 year. People are not understanding. I'm sorry, I will give you a small example. we never did small ticket transaction. But the other day I got a call from a guy manufacturing trailers, पीछे जो बड़े-बड़े trailers है. For the last 5 years, he's been doing only on his own funding. He has been given by credit being given from the steel and by the steel industry. Now the steel industry has stopped giving him credit, so he needs bank finance going forward. And there is a huge amount of strain in his cash flows today. This is one example I'm giving you. This is an example across the manufacturing sector.
Sure, get it.
So the financial strain into the system will surface in the next 1 or 2 years.
I get what you're saying. Let me go on. Kaustuv, do you think there's anything that any of the regulators need to do? Do you think there's anything that policy needs to do?
Yeah. So, I mean, one thing which I think, whether it can be short term, long term, is try to relieve financial stress through financial means may not be that possible, but I'm thinking slightly different approaches. That what if you had a limited time window of increasing FAR or FSI? Okay, because you've got to make these projects viable, right? The ones which are stuck projects viable. At this point of time, the only way you can make it viable is by giving them more FSI or FAR. You might decide that, okay, fine, you keep a window of maybe 4 to 5 years or whatever it is. Say that, okay, fine, you take in more FSI, more FAR, you complete the projects, and by getting in more FSI, FAR, you make it more make it viable, and then complete the projects. I mean, I'm looking at a rather dramatically different route, but that's what I can think of. Because otherwise, who's going to bell the cat?
Yeah. Okay.
That's what my thought is.
Yeah, Rohit, policy.
So I think at a policy level, there's two parts. One is as far as these stuck projects are concerned. I think we need a very clear-cut guideline where we put the onus to a large extent on the customer who's bought. Okay, I know this sounds blasphemous. But people will be like, oh, but the builder screwed us and so on and so forth. I understand that, but it's a mistake that's been made, right? If you bought something for, I don't know, let's say 5,000 rupees a square foot, and you've already paid 3,500, the building is half constructed, right? If you need to put, instead of 5,000, by putting in an extra 500, 800, 900 rupees a square foot more, you're going to protect your investment, right? Then that should certainly be something that gets done. Even if the project is in the negative, right? Then if it's in the negative by a small amount, then all that inventory then needs to be earmarked to be sold and proportionately given to people who paid the increased amount. Okay. Any further amounts, then you should, through a civil, criminal, whatever other suit, take it, recover it from the developer.
Yeah.
But the priority has got to be a formula where funding is provided. Somebody has to bear the hit.
Yeah.
Right? Yeah. So now one is the eventual hit, one is the temporary hit to get the home. If you've got hundreds and thousands of homes which are stuck, the government doesn't have the capital to put money in. The banks are for-profit enterprises. Yeah. Right? So who should really take the hit? There were two parties involved in this. The developer was one. Granted, he's made the mistake, but I think there's a culpability to the person who invested, got conned, all of that. I agree with that. I'm saying it's a mistake made, but I think maybe it's time for us to come forward, come together, and I'm sure the government and the RBI then can come up with a policy of saying, okay, we will consider this a priority sector top-up loan. Okay, we can afford to give that loan at a much lower rate. Okay, we reduce the pressure and the burden on those people. Let's just get them to the finish line of getting their homes.
Yeah,
we've been talking about this Swami Fund. It talks about positive, where they're not in the negative. That's a done story.
Yeah.
So what happens to those projects which are negative?
Yeah.
So I think that's on one. And I think the other thing that this real estate sector needs desperately is a degree of just stability in policy. Please, for God's sake, just stop hammering the industry with one blow after the other. Right? If we just whatever is done now, please just freeze it, implement it, and give us a 10-year run with current policy.
Okay. Will that pull the industry out of the doldrums?
Well, I think certainly when there is, look, the government of Maharashtra came up with these unified DC rules. Okay, now they've changed some FSI norms. Okay, ongoing projects which in order to convert those into the new norms, the policy and the DC rules which have been passed now say that we will come up with new guidelines for that. Again, projects which are ongoing are just hanging in midair, right? So we have no idea what happens to those kind of projects. How do we deal with treating these to go forward?
Right.
Just finish all these policies, please, for God's sake, right? Because you know what happens every time a new policy comes in, there is uncertainty around implementation. The bureaucrats take time to understand that messaging has to go all the way down to the building inspector in a municipal corporation down the line to implement that. Again, there's a new change at the top.
Yeah.
When they hear that there's a new change coming, everybody takes okay, new change coming. Let's see what happens going forward. So I think, the industry, any business needs stability.
Yeah.
And I think the real estate sector also needs that degree of policy stability. Suddenly the environment committee will come up with corporate environment responsibility. Okay. Then now they say, that what is this nonsense that just comes up from anywhere and anywhere?
Yeah.
I think we need that stability in policy as far as the sector is concerned, as far as going forward. Just let us do our job of giving people homes.
Okay.
Without bringing new hurdles in every single day.
Right. Now, I'm going to take off from what Rohit said, and Kaustuv, I'm going to come to you. He said that ultimately the buyer is as culpable as the seller, right? Mistake, whatever, but you have to bear the consequences of whatever you did, whom you chose to buy with, where you chose to buy, all that. Isn't it important that the buyer, whether it is residential or retail investments, commercial investments, shouldn't that buyer have full disclosure of where the finance came from? Was there financial closure? Who are the lenders to this project? I think it is mandated in the lending norms. It's just not followed.
See, it's a tricky point. The thing is that, see, when it comes to residential, there's always a emotional play to this. Okay, let's put it this way. When someone is buying stocks, me as a retailer, if I'm buying stocks on the stock market, how much do I examine? I don't. Okay,
but
do I go into the fundamental
research? Manager or
research?
somebody to advise me, or a financial advisor to advise me. We don't have
So,
that here in the real estate market.
Exactly. You do not have that degree of, because the level of transparency in real estate has only started emerging only now. RERA's come in and some of those things have happened. But if I look at, in the past, there was nothing. It was oblique. I mean, you had an agreement, either you take it or you don't take it. This is what you have to sign, Yeah. So I think where somewhere, there is for buyers who took that risk of taking, I mean, obviously, when they bought in something which was under construction, they knew that there was some amount of risk involved. Now it's unfortunate that some of that risk has actually become reality. Now what do you do? I mean, some places you just take a call, you get out of it. If you're not too deep into it, you get out of it. You say that, okay, fine, I made a loss and I'm getting out of it. Now that's as an investor. The thing is that where it gets tricky in residential is that because you are an end user, and when it comes to end user, the entire equation or the consideration changes as to because it's your own house, the thing is going to stay over there, and that's where I don't know how, where, what, but I think RERA, if it gets implemented properly across all the states uniformly, and if it has enough teeth, I think to a certain extent it should be able to address that. I think RERA has been a good step. I think some places it has come out well. Some states have still to, I think, implemented a thing like that. But I think RERA is a good step. But also, as individual investors or individual buyers into a property which is under construction, you need to be aware that there are risks involved. Right. And many times, I mean, I think people are sometimes ignorant of the fact that, listen, when you're doing anything under construction, there's risk. And you need to be cognizant of the risk.
Yeah.
And it's not a guarantee saying that it's not like a GSEC saying that, okay, just because I booked it, I'm going to get it on that time, on that basis, exactly the way it is shown. It's not going to happen. Most of the time, it's not going to happen.
Right. Yeah, Naresh. Actually, Naresh, I wanted to ask you, when a consumer, when the developer borrows, builds something and the consumer buys, I'm going to take you back to that point that Rohit raised. how much information should be shared with the consumer, with the buyer? And does the buyer make an informed decision? Because like Kaustuv said, things can go right, things can go wrong also. There is risk involved. Is the buyer aware of that risk, and is the lender aware of, has the lender really measured the risk? Naresh, you're on mute.
Yeah, lender, you mean to say the investor of the project?
Yes, it could be the equity investor. See, now everybody has become cautious, but when the money flowed in, even they were not aware of the risks, right?
Absolutely. So again, see, that's a business call. There are 3-4 issues to any business.
Yeah.
Now, this is a business call which a developer and a customer has to take, how much information that he needs to pass on to a consumer, how much a consumer needs to, ask information.
No,
What is this?
I think here the policymakers have stepped in and said this should be displayed to the buyer, that there is project finance that has been taken or something like that.
Which is being done, I believe. This is being done. I suppose.
Now, in some
developers are doing. I'm sure they're doing. I mean, why should we say developers are not disciplined there? They're disciplined there. Let's take that for granted. Point is, again, what has happened to the real estate sector largely, I feel, is there have been structural hits to them.
Yeah.
Demonetization, GST, RERA, and nobody. Then ILFS issue came in.
Yeah.
You see, ILFS, again, by the time the industry had stabilized a little bit, it had stabilized. After ILFS, again, it came crashing down. Again, the stability started happening. You had this pandemic coming.
Yeah.
So point is, again, I look at it only from, I'm a finance man, Jayashree, so I can only answer from, only talk about finance per se.
Yeah.
So finance per se, okay,
Quickly,
finance per se is,
left.
sorry. So that financial discipline, which has not happened earlier, it is inevitable that it should happen now going forward, 100%. Now, whether you need to disclose to the investor or not, or what, that is between a businessman and a consumer. Simple.
Right. Rohit, so last 3-4 minutes, will we see equity funds coming in? Will the industry be ready for equity funds? And what kind of returns does the industry need to give so that equity funds find it attractive?
So my own sense is, I think, firstly, I don't think that it's about a return. I think the question, for example, we have offers every single day of equity, pure equity investment into our projects, right? So if we have it, I'm sure that there are a number of other developers who also have this opportunity. The question is, how widespread does it become?
Yeah.
My own sense is, I think that the days of just blind funding are now behind us. Mm-hmm. And I think that therefore the equity investors will be a lot more circumspect. Mm-hmm. They'll ask many more questions. They'll ask for many more reps and warranties. Mm-hmm. And I do believe that at a time when developers were willing to give personal guarantees, sign any paper to get the money, having seen those deals go south and go bad, I think even developers will be a lot more circumspect. Yeah. In terms of signing that. So I think that as we go forward, the mess will kind of clean up. I think that equity. So here's the other thing, right? The more the mess, the more the risk, the more the returns expected by the equity investors. Yes. Right? So I think as the dust sort of settles, the equity investors themselves will start expecting more reasonable returns. And so it's a process. And in time, I think, yes, the industry will find its balance. We will have all kinds of financial instruments available, debt, equity, mezz. These will all come back. But it'll come back, after there is a cleanup, after there is an understanding of the markets, and after developers improve their game, and after the financial institutions also kind of improve their own game and come to terms with how they want to play this. But I think it's a matter of time. It will come back.
Okay. Kaustuv, do you think when do you think the industry will give returns enough for this?
Yeah, similar lines. It's just that you're going to see some players fall out. Okay, let the players fall out. There's some amount of cleaning process, healing process, whatever it is. Maybe it's only after 3 or 4 years when we are going to see some activity really getting into this. The thing is that Similarly to on commercial side, I think of it on the commercial side, the India's total grade A stock is about 600 million. Okay, 50% of that is managed by 9 or 10 landlords. That's it. Okay. I mean, who would have thought of that maybe 10, 15 years back? But the thing is that, yes, residential is a little bit more widespread, but I think we would be seeing some amount of the cleanup, equity will come in, and hopefully, some REIT activity, I think everybody would look at a REIT activity in residential, definitely would be a welcome. And that may be still take 5 to 6 years time.
Okay. Naresh?
Going forward, see, whatever, as I told you earlier, largely FDI has come in real estate in the commercial space.
Yeah.
Now, commercials, residential, we have seen very, very less percentage. Going forward, again, I feel that commercial space also will be a challenge in a sense. The prices, globally, assets prices will come down. There is an opportunity there. So an investor will look at India market because there is a currency risk, there is a market risk, there is a country risk or whatever. That risk is not there abroad. So going forward again, and plus again, the rentals have come down, Jayashree. The office rentals have come down, because it's that work from home concept. So again, going forward, investment again in the commercial space, I feel will be a challenge, 100%. Rohit is saying no. Rohit,
You want to counter that?
The work from home bit, I think is sort of now played out. I don't see. I think that there are some minor tweaks that are happening as a result of it. I think leasing is clearly bouncing and bounced back. There are reports about how corporates are even finding tremendous drops in productivity. And if you look at the cost of real estate as a percentage of a person's overall cost, having them work from home with that great a drop in productivity, the equation just doesn't work. So I think the work from home is certainly here to stay, but in a different avatar from what we've seen during this pandemic lockdown, when I think it was all experimental. We had no choice. It was for survival. You had to work from home. But I think as we come out of the lockdown and as the pandemic is behind us, I think we'll see things go back to a sort of new normal, which is not going to be so far from what we were used to before. That's just my assessment of it. Beyond that, I think it's an overall cyclical kind of ups and downs. You see minor ups and downs. As a result of the risk in the industry, there's also the aspect of new projects also going on to the back burner. Yeah. So those projects which are in and which are on the ground, these projects are long cycle projects, right? So and I think that's a discussion for another hour. So I'll just kind of.
That's right. I was going to say that I just wanted a quick counter because. Commercial, we are going to focus on the finance in another show, but I just wanted a quick counter. Prabhakar, you want to say something before we close? We are actually over time, but
one thing, just you were asking the question on the transparency.
Yes.
Now the issue in India is like Dwarka Expressway. It's supposed to be completed by 2012. Even if the developers were very transparent, telling everything upfront, but nobody knew that this Dwarka Expressway will not be completed even by 2021. Similarly, like Noida Expressway, this Noida extension, nobody knew that Allahabad High Court will give the judgment that land should be returned to the farmers. So this kind of a risk is creating havoc in the real estate sector. And this has created all this mess. And so long as this mess is not cleared, I don't think that any new projects, particularly in NCR region and MMR Mumbai, will be viable at the realistic price. Of course, at the price what they are showing on the paper, at that price that might be the viable, but then will they be able to realize that price? I doubt. And so the projects, I don't think they can go in the route.
Naresh, you can take 20 seconds, not more than that, because we're really...
Yeah, I'm going to add what Rohit said. Work from home concept is just a minuscule thing. Overall, if you look at it, global asset prices will come down. So they will look at opportunities there as well. Second is, insofar as my investment in India is concerned, what is the, whether I'm able to attract in the manufacturing sector or not investments going forward? How much India is able to attract? So that will give me an incentive for an investor to come into real estate as well. Work from home concept is hardly maybe 5%, 10% factor, not a huge factor.
Right.
But these two factors are the major factors going forward.
That will
That's
drive the
it. Thanks.
residential also.
Yes.
Absolutely.
And while we see things dipping in one segment, I think the completion of infrastructure projects is going to be something that will drive another wave of real estate, because we are at 35% urbanization. We are going to hit 50% in the next 10, 15 years or so. So there is a huge opportunity here. The discussion is that will there be enough finance chasing the development of these cities? Thank you so much for joining the property show, and thank you all of you for joining me.
Thanks, Jayashree.
Thank you.
Great as
Thank you,
always.
Jayashree. Thank you
Bye.
all. Bye-bye. Bye-bye.